You and others have spoken about the possibility that Trump's tariffs were more of a bargaining tactic to secure better trade deals and or get particularly the European countries and possibly others to fund more of the defense spending globally. Now that we've seen a little bit of this play out, what do you think of that now, JP?
Well, thank you, Eugene. And I think it's appropriate every time we speak, Eugene, because it's only once every 3 months, that you do say there's been a lot going on. Look, I've been doing this for 41 years, and you know I'm a self-confessed current affairs, news, market data junkie. I can tell you, Eugene, without any hesitation, that this is by far and away the most fascinating time that I've experienced in financial markets. And I spoke at an event earlier this week, and I said that I feel my 41 years in the financial markets has led me to this moment in time, because we are indeed witnesses to a remarkable watershed moment in time. So let's talk Trump. And Trump, in the news not every day, every minute of every day. He loves the headlines, and he is certainly the headline wherever you are in the world. And obviously, if we're talking tariffs, we have to talk Switzerland. And if we're talking Switzerland, it is the remarkable meeting. Now we know more and more detail about the meeting over last weekend between US Treasury Secretary, obviously, and US Treasury Secretary Scott Bessent, assisted by US Trade Representative Jameson Greer, and their counterpart in China, Vice Premier He Lifeng. In fact, he is spelled He, but is pronounced Ha. So it's Ha Lifeng. It looks like the meeting went remarkably well at a personal level in terms of the personal chemistry. We know that because the American delegation told us that afterwards in a press conference, which if any of you have the time, is a must watch. But the bottom line is we saw a dramatic reduction in the tariffs from, if you remember, if you're keeping score on the tariff war, US had 145% on China. China had 125% of the United States. The United States has brought the 145% down to 30%. But actually, if you look into it in greater detail, the net figure is near 40%. I won't go through the arithmetic because there were a lot of pre-existing tariffs, which you remember from Trump's first time in government. Then Biden continued those. And then, of course, Trump came straight in with a fentanyl 25% levy. The bottom line is the discussions went better than anyone anticipated, certainly better than I had anticipated. I thought this was more of a get-to-know-you kind of meeting. The Chinese delegation didn't know or not familiar with Scott Bessent. They were familiar with Jameson Greer, who was actually chief of staff under Robert Lighthizer, who was the key US trade point person in the first Trump administration. The bottom line is they've now got a framework for further discussion, and the punitive tariffs that Trump had imposed upon China have been paused for 90 days as they work through things. Fentanyl was front and center, and anyone who follows the US news cycle will know that fentanyl has been a big issue for Trump, and he's spoken repeatedly about it on the campaign trail and subsequently as well. So there seemed to be some really good traction and progress on that one. But also in a broader sense, it looks like, and I know everyone's asking the question, who blinked first? And in a kind of way, it doesn't really matter who blinked first. My take, and I'll be certainly writing about this in my forthcoming pain report, is they both blinked because both appreciated that a decoupling of the Chinese and US economies was simply not feasible. And I've been writing about this, and I've asked the question in my pain report. And by the way, if I can, thank you to many of you at Lifespan who've subscribed recently to the pain report. It actually makes these conversations so much easier because you know the context of my perspectives and opinions. So there's so much happening. I can keep you up to date through the weekly pain report. But the bottom line is the United States was in dire straits if it was attempting to decouple from China. Ditto, the Chinese realized that they were in dire straits as well, with 145% tariffs being a de facto trade embargo. So both have stepped back from the brink and acknowledged that the kind of linkages and dependencies between these two economies, the largest in the world, obviously, are something that just cannot be unplugged. They've both come to that realization. So look, what it did for financial markets, obviously we gapped higher in the Monday session, just gone actually. What day is it today? Wednesday. And it removes, I think, at the extreme, the kind of so-called tail risk of a real economic Armageddon. And obviously also somewhat pares back some of the kind of recessionary risks, because we'd seen already, Eugene, a significant decline in freight orders and ship movements from China. We have satellites tracking the number of container ships that were moving across the Pacific into the west coast of the United States, and forward freight orders had collapsed, truck tonnage had collapsed, so on and so forth. So the other thing I'll say quickly, and I know we've got to move on to so many other things, there was an incredibly important meeting between the chief executives of Walmart and Target that took place in the Oval Office recently, and both those CEOs of two of the largest grocery supermarket chains, stores in the United States, really impressed upon Donald Trump that the shelves at Walmart would be not well stocked in 6 to 8 weeks' time. We knew from all the freight data that there was trouble ahead. And also a statistic that I've used repeatedly in my pain reports recently, the one that I've asked every single person to try and memorize, is that 40% of all Chinese goods that come into the United States, 40% of all Chinese imports into the United States are so-called components or inputs into final finished goods. So there are a number of businesses, particularly in the smaller business sector, that were literally going to be wiped out if you attempted to unplug in a single instant the Chinese economy and supply chains from the US economy.
Yeah, absolutely. So it's been interesting to watch it play out. I feel as though the way it has played out perhaps confirms that it was a bargaining type strategy. I'm not convinced that Trump really wants to bring manufacturing back in a massive way. I think it was perhaps more about securing. I know that was his pitch. But when you think about the lead time of building new factories and getting, it's a 5 to 7 year proposition. He's only going to be in power for 4 years. It's a lot of investment in such an uncertain environment. So I'm not convinced that was the real motive behind it. I think it was more about securing trade, and perhaps it's just another tax to help pay for some of the tax cuts that he's promised and will look to deliver, I suppose. And I guess that leads me to the next part. Going back to our last episode, we discussed the potential positive fiscal and market impacts of a Trump administration, which is, what the stock market did. It took off like a rocket after he got elected, focusing on tax cuts and potentially some of the other positives. And then we saw how, as soon as he actually came out with some of these tariffs, or proposing tariffs, we saw what happened in markets in March and April. And now that they've been unwound, you can see markets rallying again. So it'll be interesting what happens next. But, is it time to reevaluate, given what's happened, the US as a major economic power over the next 6 to 12 months?
Yeah, it's interesting, isn't it? So, just to emphasize your point, if we go back to, Liberation Day on April the 2nd, when we had the full shock and horror of the scale of these tariffs, particularly these so-called reciprocal tariffs, and we won't get into the arithmetic behind them. You recall that from the February 19th high on the S&P 500, we fell 21%. Into those lows on around, I think it was April the 7th. So it was one of the fastest declines we've actually ever witnessed. Obviously, 87 stands out as a special case, and COVID is another one. But I mean, in terms of since 1929, it was like the third or fourth fastest decline, or so-called crash. If you define a crash as a 20% decline, that's just a numerical number that Wall Street talks about. And then, of course, the NASDAQ fell by even more. And then the really kind of racy sectors, such as the SOX, the SOX, the Philly Semiconductor Index, fell even more, significantly more, in fact. And so from that Feb 19 peak down to that April 7 low, it was a fast and furious decline. And the markets became incredibly oversold. And the fascinating thing that I've learned in 41 years, whenever the markets fall as fast as that, they always bounce every single time. There is, without exception, because the so-called fast money, the more aggressive money, the hedge funds, the CTAs, certainly the algos and others, and even people like myself, the kind of people who trade markets, are getting aggressively short. How do they make money? Is by obviously closing those shorts. So they have to buy back in, and that gives you the bounce. So it was a very, very, very sharp decline. We've now haven't fully erased the decline. Obviously, we're not back at the Feb 19 highs. We're about 4.5% below on the S&P 500. But also, what I find fantastic, and I've been articulating this in my pain report, at times like this, Eugene, I use technical analysis. I probably at a time like this more heavily rely on technical analysis because the economic data is just noisy and it's real late. I mean, when you have an event such as Liberation Day on April the 2nd, what's the point of even looking at the economic data? Because everything pre-Liberation Day is completely irrelevant, It's only data not even immediately past April the 2nd. It's only data 6 to 8 weeks down the road that we're going to be able to look at. And what we can say right now is if he had maintained 145% tariffs on China and hadn't, by the way, we haven't even talked about the pause, which Scott Bessent intervened and engineered. If we'd maintained the same tariff levels that he unveiled on April the 2nd, I mean, the soft data, which already was soft, i.e. the so-called survey data, would have certainly translated into not just soft, hard data, we'd have gone headlong into a recession. So that's what we were staring at, and that's what the stock market was telling us. But then Scott Bessent, the Treasury Secretary, intervened. I wrote about this in my pain report as well. I actually was begging Bessent to go to Mar-a-Lago on the weekend and talk to Trump and say, we need a timeout. And he got a timeout. He got Trump's ear. And this is something I want everyone listening to this recording to understand. Scott Bessent is absolutely critical I mean, Trump might be the most powerful individual in the world, and Jerome Powell's very influential. I would argue Bessent is right up there. And without Bessent's intervention, we were looking at a very bleak situation. But, Bessent intervened and said, Mr. President, you need to take a time out here because I'm getting all the intel. And because, Scott is a very, very, very accomplished global macro hedge fund manager. So he's global macro, Eugene, like I'm global macro. And he puts that jigsaw puzzle together every day. And what he was seeing was very alarming because we saw, Eugene, if you recall, we had a very unusual event occurring, Eugene. We had a simultaneous collapse in the stock market in the United States, a very sharp rise in bond yields, accompanied by a very sharp decline in the US dollar. But let me just bring the tariff discussion to a reasonably brief close, although I promise you I could talk for days just on that one topic. So the basic universal baseline is 10%. They're not going to budge on. Every country is going to have a minimum of 10%. We have the special deal with the UK, but don't forget we've got a special relationship between the United States and the UK, long-term allies, so on and so forth. China now, we've got a process, a framework for further discussion. We're not out of the woods on the China trade conversation by any means, but we're back from the brink of what could only be described as kind of economic Armageddon. As a consequence, the markets have rallied. Now, the other countries, we know India's well down the road to getting some kind of agreement. India's critical in a geopolitical framework. I mean, we haven't even got time to talk about India, Pakistan, but there was a US intervention, as we know. J.D. Vance and Marco Rubio, the US Secretary of State, intervened there, and so did Trump, incidentally, and just told both sides to just stop. We were very close to something very serious happening, both of them nuclear armed. But anyway, India is coming to the table, and that deal looks like it's going to be not too far away. Japan, things are a little bit slow on the trade discussions. South Korea, ditto. The EU is going to be more complicated. One of the things about Trump, which I think by now we should all know, he's hyper-personalized. If he likes an individual and he enjoys the conversation and the back and forth, he'll provide some concessions. We all know, I mean, it's no surprise, he really doesn't like Europe. He doesn't like the European Union, doesn't like what it represents. He's annoyed with Europe. We know that America's stepping back from Europe and asking the Europeans to defend themselves, that the United States is no longer going to be the policeman of the world and not Europe. That negotiation with the EU is going to be more problematic. So this is not the end of the tariff conversation. I mean, this is the early innings of it, but we have to acknowledge that we're in a better place today than we were prior to the meeting in Switzerland. And so the markets, in my view now, are probably going to consolidate as we start getting information about the EU, for example. The European Union trade deal is going to be really complex. And I think Trump is probably not going to drop it, say, to 10% like he has with the UK. So we mustn't use UK as a template because it's very unique. Because also don't forget the UK has a trade deficit with the United States. So let's work that the other way around. The United States has a trade surplus with the UK, one of the few countries where that is the case. The other one, of course, is ourselves here in Australia. And we're going to be reasonably well treated. We'll probably get a 10% tariff on our stuff, but we don't really move the dial when it comes to the kind of global matrix of global trade. So no doubt that where we are today, what is it, the 14th of May, there's a kind of sigh of relief. And as a consequence, markets rallied very, very sharply. But we're now in a situation where we had been very oversold. We're now very overbought. So we're going to probably consolidate. The good news for someone such as myself is the charts really worked in this environment. The charts were forewarning that the market was rolling over prior to the crash. And now on the other way, they were basically saying we needed to rally. We needed to rally. We've unwound the oversold condition in a dramatic fashion. I now think we're going to have some more consolidation.
So when you say consolidation, you feel as though the market's going to trade sideways, or you think there's going to be a bit more of a drop?
Yeah, I think we could actually trade off a little bit in the next couple of weeks or so. The problem with 2025, and I think this is one of the key characteristics of this year so far, is that it's going to require almost a different operating environment because we've got Trump, and it's a highly geopoliticized environment. I know we're probably not going to talk about the axis of autocracy today, but at the end of the day, we've got this global environment where there are so many very, very important geopolitical balls in the air. We've got Gaza, Israel, we've got Ukraine, Russia, or Iran is front and center. And I hope all the people listening to this take the time to listen to what Trump said in Riyadh about 5-6 hours ago. Iran is front and center. What do China and Russia think about that with regard to, what might happen next in Iran? So everything is to play for here. The stakes are very, very, very high. But the China Armageddon scenario is now off the table. That what we call that kind of so-called tail risk. So we had first quarter GDP, Eugene, down -0.3. We know why. And again, I explained that in my pain report, the calculus, the arithmetic, because we had that surge in imports front running the implementation of tariffs, and that's subtracted from GDP. Q2 is going to be very, 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 very noisy. But at the end of the day, the United States economy got a real big shock. We saw massive declines in business confidence, consumer confidence, small businesses saying they were in strife. That is probably going to improve now. Yes, that will improve. But I don't think we're completely out of the woods, because the other thing we've got to bring back into play is a Fed that's on hold. I think for the foreseeable future, and Jerome Powell went to some lengths to say that to us in that recent press conference.